All right, let's talk about investing. If you want to grow your money for the long haul, you've probably been told you need to be in the stock market. But where on earth do you even start? And that's exactly what we're going to tackle today using a super powerful tool called an equity fund.
So, does this sound familiar? You know you want in on the stock market's potential for growth, but when you look at the thousands and thousands of companies out there, that starting line can feel totally out of reach.
And look, that feeling is totally normal. It's like being dropped into a massive, complicated maze with no map and no compass. Which company is the right path? Which one's a dead end? The sheer volume of choices can be just paralyzing.
But what if I told you there's a guide, a tool that's literally designed to get you through that maze? Well, that is precisely what an equity fund is. So let's break down exactly what that means.
Okay, so here's the basic idea. Instead of you trying to buy one share of just one company, an equity fund pulls together money from tons of investors, people just like you. Then it uses that big old pool of cash to buy a whole portfolio of different stocks, all at once. You know, the easiest way to think about it is like a pre-made gift basket. You're not going around the store picking out every single individual item. Nope, you're buying a basket that an expert has already put together for you, packed with all sorts of different goodies.
And right away, this gives you two incredible superpowers. First up, diversification. Because you own tiny pieces of many stocks, you're not putting all your eggs in one basket. If one company has a bad quarter, it doesn't sink your whole investment. And second, professional management. You don't have to stay up all night researching balance sheets. An expert, a pro whose full-time job this is doing it for you.
Okay, so you're on board with this whole basket idea. Awesome. But just like going to an ice cream shop, there are a whole lot of different flavors. And the key is finding the one that actually fits your personal tastes and, more importantly, your financial goals.
Now, your first huge choice is going to be between active and passive funds. Think of an active fund manager as a celebrity chef trying to invent a brand new, amazing dish that's going to beat the competition. They are actively picking and choosing stocks, trying to outperform the entire market. A passive fund, on the other hand, is more like a cook who follows a classic, trusted recipe to the letter. It doesn't try to be clever, it just tries to perfectly copy a market index, like the S&P 500, and match its performance. And here's the kicker. Because it's way less work, passive funds almost always have much lower fees.
Okay, get ready for this because it sounds completely backwards, but it's maybe the single most important thing to know about investing. History shows, time and time again, that once you factor in their higher fees, most of those celebrity chef active funds actually fail to beat the simple, recipe-following passive funds over the long run.
All right, so once you've wrapped your head around active versus passive, the next question is all about size. Are we investing in the established giants of the world, or are we looking for the scrappy up-and-comers?
We do this using something called market cap. Now, don't worry, that's just a fancy way of saying a company's total value. Large cap funds invest in the huge, well-known, stable companies. Mid caps are those companies in a serious growth phase. And small caps are the young guns. They've got huge growth potential, but yeah, they also come with higher risk.
And the last big flavor to choose from is the investment style. Are you looking for growth or are you looking for value? Growth funds are betting on companies that are expected to grow like weeds, and they just pour every penny they make right back into growing bigger. Value funds are kind of like bargain hunters. They're searching for good, solid companies that they think the market has unfairly overlooked. And these companies often reward their shareholders by paying out profits as dividends.
Okay, so we've browsed the menu, we've picked our flavor. But before we dig in, we have to have a very real, clear-eyed chat about the two sides of this coin, the incredible rewards and the very real risks.
So, let's talk rewards. What's the upside for taking on all this stock market risk? Well, history paints a really clear picture. For nearly a century, the stock market has returned, on average, over 11.5% a year. Now compare that to a much safer option like corporate bonds. That difference, that right there, is the engine that can seriously build wealth over time.
But, and this is a huge but, that journey is never, ever a smooth ride up. It's a bumpy, sometimes scary road. To earn those higher long-term rewards, you simply have to be willing to stomach the volatility along the way.
So what does that risk actually feel like? Well, a few things. Market risk means sometimes the entire market goes down together. It doesn't matter how great your individual companies are. Volatility means your account balance can swing up and down in a big way from one day to the next. And that means you have to be ready for short-term losses, seeing your investment value actually drop below what you put in. It happens.
All right, let's put it all on the scale. The bottom line. The pros are huge. You get access to higher potential long-term returns, instant diversification, and professional management. The cons are just as real. You're signing up for higher volatility and the risk of loss, plus you could get stuck with high fees, especially in those active funds. Getting comfortable with that trade-off, that is the absolute key to being a successful investor.
Okay, we've covered the what, the why, and the watch out fors, so now let's get to the really exciting part. How do you actually do this? How do you take that very first step?
Believe it or not, it really boils down to 3 simple steps. First, define your goals. What are you investing for? Retirement in 30 years? A house down payment in 5? That timeline is going to tell you how much risk you can comfortably take. Second, do a little research. You can use free online tools to find funds that match your goals, and then just take a peek at the fund's official rulebook called a prospectus to check its strategy and fees. And third, open an account. You can do this in minutes online with any major brokerage. Connect your bank, and you're ready to go.
So, when you boil it all down, that's what an equity fund is. It's not just an investment. It's a powerful tool. It's one single thing you can buy that gives you professional oversight, diversification, and a direct ticket to the stock market's potential for long-term growth.
You know, we started this whole conversation talking about the stock market like it's some kind of confusing maze. Well, guess what? You've got the map now. You understand the different paths, active versus passive, large companies versus small, growth versus value. So the only real question left is, what are you going to explore first?